When you pass 50, money changes its meaning again. Not suddenly, not dramatically, but quietly. The way time changes when you realize a year no longer feels long. It feels specific. It feels countable. At this stage, money is no longer about ambition or experimentation. It becomes about preservation, stability, and dignity. Yet this is also the age when many people unknowingly make the most dangerous financial mistake of their lives. Not because they are reckless, not because they lack intelligence, but because they misunderstand what the second half of life requires. The mistake is not a bad stock pick. It is not a market crash. It is not even a failed investment. The real mistake is continuing to invest as if time is still abundant. This error does not announce itself loudly. It does not feel irresponsible. In fact, it often feels logical, even necessary. Many people over 50 believe they must make their money work harder to catch up, protect themselves from inflation, or ensure a comfortable future. That belief alone has quietly undone more financial plans than any recession ever has. Earlier in life, risk is forgivable. At 25 or 30, mistakes are tuition. At 50, mistakes are permanent. Not because recovery is impossible, but because recovery demands something you can no longer replace: time. I learned this lesson slowly, by watching others first, and then by recognizing it in myself. For years, I believed good investing was about optimizing returns, finding better opportunities, being slightly smarter than average, avoiding obvious errors. What I failed to understand was that the rules of investing change with age, even though markets do not. Markets do not care how old you are. They do not slow down for you. They do not become gentler because your timeline has shortened. And that mismatch is where danger begins. One of the most common patterns I see among people over 50 is an unspoken urgency. It rarely shows up as panic. It appears as quiet pressure, a sense that things should already be settled, that the heavy lifting should be done. When reality does not match that expectation, the response is often to increase risk, not reduce it. This is where the mistake takes shape. People begin chasing returns they would never have needed in their 30s. They allocate more capital to volatile assets. They tolerate swings they no longer emotionally recover from. They convince themselves that experience compensates for risk, but experience does not change arithmetic. Losses still compound faster than gains. Volatility still erodes confidence. And confidence, once damaged later in life, is harder to rebuild than money itself. I once spoke with a man in his early 60s who described his portfolio as aggressive, but informed. He had done well during strong markets. He understood the businesses he owned. He followed financial news closely. On paper, he looked disciplined. But during a major downturn, his behavior changed. Not because he lacked knowledge, but because the losses felt different this time. Each decline carried the weight of finality. There was no long runway to emotionally distance himself from mistakes. Eventually, he sold at exactly the wrong moment, not due to ignorance, but fear. Fear at 30 feels temporary. Fear at 60 feels existential. One of the biggest mistakes I see people make, especially as they get older, is investing as if time is unlimited. When you're young, risk feels kind of abstract. A market drop? Meh. You have decades to make it back. But by the time you hit 50 or so, those same swings can hit you in ways that aren't just financial, they're emotional. Watching your portfolio fall can set off fear, panic, and all kinds of knee-jerk decisions. Sell at the wrong time, delay retirement, make a move that undoes years, maybe decades of careful planning. At this stage of life, risk isn't just numbers on a screen, it's what happens upstairs in your head. Here's the tricky part. This mistake often hides behind good intentions. Folks tell themselves they're being responsible, guarding against inflation, staying invested, not being too conservative. Those aren't bad intentions. But intention alone doesn't cut it. You can be cautious all you want, But if your strategy isn't suited to your current situation, you're still taking a big risk. Conservatism isn't the enemy. Misalignment is. Clinging to strategies that made sense in your 30 seconds or 40 seconds just because they feel familiar is a bit like driving a car designed for city streets on a mountain pass. You might get there, but it's going to be a bumpy ride. By the time you're 50 and beyond, your financial priorities shift quietly, often without you noticing. Growth is still important. You want your money to keep up with inflation, and you don't want to run out of it too soon. But growth isn't the main event anymore. The spotlight moves to resilience, the ability to weather storms without making irreversible decisions. That means having a portfolio that can handle market drops without forcing panic sales. It means enough liquidity to deal with emergencies without raiding your retirement savings at the worst possible time. It means sleeping well at night without obsessing over your account balance, knowing short-term turbulence won't wreck decades of careful planning. Building this kind of resilience takes intention. You might need to tilt your portfolio toward less aggressive investments, bonds, dividend-paying stocks, or other income-focused assets. Make sure your emergency fund is robust. Stress test your retirement and long-term care plans against bad scenarios. The goal isn't to eliminate risk entirely. That's impossible. The goal is to manage it in a way that fits your life stage, your responsibilities, and your capacity to handle uncertainty without losing your cool. Here's the hard truth. What worked when you were 35 won't necessarily work when you're 55. Chasing growth as if you have endless time puts both your money and your peace of mind in jeopardy. But if you embrace resilience, if you align your strategy with the reality of where you are now, you build a foundation that's far sturdier. At this stage, investing isn't just about growing wealth. It's about protecting it, preserving it, and living your life without constantly worrying about what the market might do tomorrow. And if there's one thing we can say for certain about markets, it's this: they will fluctuate, and the goal is to be ready when they do. Many people never adjust their approach to reflect this shift. They continue using the same mental framework they had at 35, even though the stakes are now far higher. A 20% loss at 35 is uncomfortable. A 20% loss at 60% can permanently alter retirement plans. Yet the market does not differentiate by age. It delivers outcomes the same way to everyone. This is why the most dangerous mistake after 50% is not taking risk itself, but taking unnecessary risk. Unnecessary risk is the kind of risk that, if it succeeds, does little to materially improve your life, but if it fails, can cause severe damage. Younger investors can often afford this risk because time allows them to recover. Older investors cannot. The consequences are more immediate, and the room for error is smaller. What makes this mistake particularly destructive is that it compounds emotionally before it compounds financially. Each volatile market swing chips away at confidence. Each headline feels heavier. Each downturn feels more personal. Over time, this emotional erosion begins to dictate decisions. People react not to their long-term plan, but to short-term discomfort. Once reaction replaces discipline, the financial damage accelerates often faster than they realize. There's another, often overlooked layer to this mistake: identity. By the time people reach midlife, they have spent decades building a sense of themselves as capable, competent decision makers. They've navigated careers, managed households, made important investments, and generally handled life's complexities with a reasonable degree of success. Over time, this history of making sound choices becomes a central part of their self-image. They are proud of their judgment, confident in their experience, and accustomed to being in control. This identity, however, can create blind spots when circumstances change. Admitting that a long-standing strategy no longer fits one's current situation can feel, in some way, like admitting personal decline. If someone has always prided themselves on being a savvy investor or a careful planner, the idea that their approach may now be inadequate is uncomfortable. It challenges not just their choices, but also the story they tell themselves about who they are. As a result, rather than adapting, they often double down on what they know. They justify risky or outdated decisions using logic, experience, or familiarity. They convince themselves that if something has worked in the past, it must still work today. In reality, familiarity is not the same as suitability. This attachment to identity can be subtle, but it is powerful. It acts like a psychological anchor, keeping people tied to strategies that may no longer serve them, even when objective evidence points to a need for change, market shifts, new personal responsibilities, health considerations, or approaching retirement. The pull of identity can create resistance. People may ignore warnings, rationalize risks, or reinterpret data to fit their narrative. They tell themselves, I've done this successfully before, I can handle it again, even when conditions have dramatically changed. The danger is that this resistance produces a mismatch between strategy and reality. What worked 20 or 30 years ago may no longer be appropriate for current needs, and investment approaches that once prioritized growth may now be too aggressive for someone who needs stability and income. Career decisions that once thrived on risk-taking may now jeopardize retirement security. And yet, because identity and past success are so closely intertwined, the mismatch often goes unnoticed until consequences become unavoidable. Recognizing this dynamic is crucial. It requires separating self-worth from past performance and viewing strategies objectively. Success in midlife and beyond depends less on repeating old patterns and more on adjusting to new realities. The most resilient decision makers are those willing to question familiar approaches, consider their present circumstances, and adapt without seeing such change as a personal failure. By doing so, they preserve both their financial health and the sense of competence that comes from making wise, timely decisions. In short, the invisible barrier of identity can be just as risky as market volatility or economic uncertainty. A strategy that aligns with who you were may no longer align with who you are, and recognizing that is the first step toward lasting security and peace of mind. The solution begins with perspective. Understanding that financial goals evolve over time is critical. The strategy that supported wealth accumulation in your 30s and 40s may no longer be appropriate in your 50s or 60s. At this stage, resilience is not just a preference, it is a requirement. It protects against irreversible setbacks, preserves options, and allows you to make decisions from a place of confidence rather than fear. Adjusting strategy doesn't mean eliminating all risk. Growth still matters, but it must be balanced with durability. This balance requires honest assessment, careful planning, and sometimes a willingness to let go of approaches that once felt safe. The key is to take risks that have meaningful upside and limited downside. Risks that serve your life goals, not your ego. In short, the most dangerous financial mistake after 50 is risk that is unnecessary, emotionally taxing, and identity-driven. Avoiding it requires clarity, self-awareness, and a shift from chasing gains to preserving flexibility. By embracing resilience, you ensure that market swings do not control your decisions and that your long-term goals remain intact, even in turbulent times. But investing is not about identity. It is about alignment. Alignment between time horizon and strategy. Alignment between emotional tolerance and volatility. Alignment between life needs and financial structure. Without alignment, even a smart strategy becomes dangerous. I realized this personally when I took the time to review my own decisions over a long period. The mistakes that hurt me the most later in life were rarely technical errors. They were timing errors driven by emotional pressure. I thought I was informed. I thought I was confident. But confidence alone does not eliminate stress. It amplifies it when outcomes turn negative. Feeling certain does not make markets predictable, and it does not make human emotions disappear. Earlier in life, volatility feels like movement, A sudden drop in the market can be thrilling, a chance to buy, a challenge to prove skill. Later in life, the same volatility feels very different. It feels like erosion, slow, quiet, and relentless. Each swing chips away not just at the portfolio, but at confidence, at patience, and at the mental space needed to make rational decisions. This is why many people over 50 eventually retreat from investing altogether. After one or two severe emotional hits, they move entirely into cash or overly conservative assets. They lock in losses and miss the eventual long-term recovery. The irony is painful. The risk they took to protect their future ends up undermining it. What they intended as a safety measure becomes the very thing that prevents growth, leaving them more vulnerable to inflation, opportunity cost, and reduced retirement flexibility. Avoiding this mistake requires a difficult shift in mindset. It requires accepting that maximum returns are no longer the goal. The focus must shift towards sustainable returns, predictable returns, and returns that support your life rather than dominate it. This doesn't mean abandoning growth altogether. It means redefining it. Growth after 50 should be quiet. It should be consistent. It should feel almost unremarkable. If your investment strategy at this stage feels exciting, thrilling, or high adrenaline, it is rarely a sign of sophistication. More often, it is a warning sign that risk has outpaced prudence, that emotion has begun to lead decision-making. At this stage of life, excitement in investing should come from confidence, clarity, and control, not market swings or speculative bets. I often think of investing after 50 as more like sailing than racing. In a race, speed is everything. You push hard, take risks, and accept crashes as part of the game. The thrill is immediate and the stakes are understood. Winners gain, losers learn, or crash spectacularly. Sailing is different. Sailing requires patience. It requires reading the weather, adjusting sails gradually, and accepting that progress may be slow. The goal is not to impress anyone watching from the shore. The goal is to reach the destination intact. This analogy highlights a critical truth. At this stage of life, investing is no longer about proving skill or beating benchmarks. It is about endurance, resilience, and preservation. It is about constructing a financial life that can withstand shocks without forcing hasty decisions. It is about making sure that temporary setbacks never become permanent disasters. This does not imply fear or avoidance. It implies thoughtful engagement. You still invest in equities and growth assets and opportunities, but only within boundaries that respect your timeline, your goals, and your emotional tolerance. You seek growth quietly without needing it to thrill or validate you. You understand that the compounding advantage now works best when it is steady and predictable. The emotional dimension cannot be overstated. As humans, we are wired to respond to loss more strongly than to gain. In early life, this bias may teach discipline, resilience, and prudence over time. After 50, it can trap us. A single shocking downturn can lead to overreaction, a complete retreat from risk, and a permanent underperformance. Awareness of this tendency is the first step in countering it. Ultimately, the lesson is simple but difficult. Investing later in life is about mastering patience, not chasing thrills. It is about building a portfolio that feels safe because it is safe, that grows because it is structured to grow, and that allows you to sleep at night even when the world feels uncertain. The quiet victories, the steady returns, the avoided mistakes, the preserved capital matter far more than headlines, tips, or temporary gains. In this way, investing after 50 becomes less about competition and more about navigation. It is about knowing when to adjust, when to stay the course, and when to simply ride out the storm. It is about protecting what you have built while still allowing for growth in a way that serves your life, your family, and your future. In short, the goal is not excitement. It is endurance, resilience, and quiet success. Many people never make that transition. They continue racing long after the race no longer matters. Another dimension of this mistake is overestimating flexibility. In your earlier years, income is adaptable. You can work more, change jobs, take risks with your career to recover losses. After 50, income often becomes less elastic. Responsibilities increase, health considerations emerge. Energy becomes finite. That means financial mistakes draw from a narrower pool of recovery options. Yet paradoxically, this is when people often take the most risk. Why? Because time feels louder. When time feels abundant, people behave patiently. When time feels scarce, people behave urgently. Urgency pushes people toward concentration, leverage, and speculative behavior. It narrows focus. It amplifies risk. It reduces margin for error. Urgency is not wisdom's partner. The calmer approach is almost always the wiser one. Accepting reasonable returns, prioritizing diversification, protecting capital, designing systems that require fewer decisions. These choices rarely feel impressive. They feel conservative. But conservative is not a flaw at this stage. It is respect for reality. One of the hardest lessons to accept after 50 is that avoiding big mistakes matters more than finding big winners. A portfolio that never suffers catastrophic loss does not need brilliance. It needs discipline. And discipline is less about willpower than structure. Structure removes emotion from decisions. Structure limits how much damage any one mistake can cause. Structure protects you when judgment falters. This is why simplifying becomes powerful later in life. Fewer holdings, clear allocation rules, automated contributions, limited exposure to financial noise. These are not signs of disengagement, they are signs of maturity. Noise is especially dangerous after 50. Financial media thrives on urgency. Every headline implies action. Every forecast suggests opportunity or danger. But reacting to noise when your timeline is short is costly. Each reaction increases friction. Fees accumulate. Taxes erode returns. Emotional fatigue builds quietly. I noticed that my most peaceful investment periods coincided with times when I paid the least attention, not because nothing was happening, but because I stopped interfering. I trusted the system rather than my impulses. The results were not dramatic. They were steady, and steady became reassuring. This is another truth many people resist. Peace of mind is a financial asset. A portfolio that grows slightly slower but allows you to sleep well is often more valuable than one that grows faster while keeping you anxious. Anxiety leads to mistakes. Calm supports consistency. Over decades, consistency wins. The mistake of over-risking after 50 also damages something less visible but equally important: optionality. When you protect capital, you preserve choices about work, choices about location, choices about lifestyle. When you expose capital to unnecessary risk, you narrow those options. Freedom after 50% is not about maximizing wealth. It is about maximizing flexibility. Flexibility requires reliability. Reliability requires discipline. Discipline requires acknowledging that your strategy must evolve as you do. Many people intellectually understand this but emotionally resist it. They fear that being more conservative means giving up. That fear is misplaced. Adjusting strategy is not surrender. It is adaptation. And adaptation is a strength. I have seen people with modest portfolios live remarkably secure lives because their expectations were aligned and their risk was controlled. I have also seen people with impressive portfolios live with constant stress because they continued gambling emotionally long after the odds turned against them. The difference was not intelligence, it was restraint. If you are over 50, the most important financial question is no longer how much can I make? It is how much can I lose without changing my life? That answer should guide every allocation decision. Loss tolerance is not theoretical. It is emotional. It is about how you respond when markets fall 20, 30, or 40%. If those scenarios would cause panic, selling, or sleepless nights, the risk is already too high, regardless of expected return. The market will test you. It always does. Mistake is assuming you will react calmly simply because you have experience. Experience does not eliminate emotion, it deepens it. You have more to protect now, more history, more responsibility. This is why investing after 50 should be designed to be almost boring. Boredom protects you. It reduces temptation. It minimizes regret. It keeps you from trying to fix things that do not need fixing. One of the quiet advantages of aging is clarity. You no longer need to prove anything. You no longer need to chase validation. Investing should reflect that. It should support your life, not compete with it for attention. The greatest financial risk after 50 is not missing out on upside. It is forcing yourself into downside you no longer recover from emotionally or financially. Time does not need to be defeated. It needs to be respected. Respecting time means choosing durability over excitement. It means letting compounding work quietly rather than demanding it perform theatrically. It means recognizing that enough is powerful. When you understand what enough looks like, the urge to chase more fades. You stop measuring success by percentages or headlines and start measuring it by stability, flexibility, and calm. Your focus shifts from outperformance to endurance, from proving skill to preserving what matters most. That shift changes everything. If you are over 50 and your investment strategy still depends on being right often, still requires frequent decisions, or still exposes you to outcomes that could dramatically alter your life, then this mistake is already present. The mistake is subtle because it masquerades as confidence and competence. You may feel in control, but in reality, you are exposing yourself to risks that younger investors could afford, but that now carry consequences you cannot easily recover from. The solution is not dramatic change, it is thoughtful adjustment. It is the quiet discipline of reducing unnecessary risk, simplifying where possible, and prioritizing protection over excitement. You focus on growth that serves life, not ego. You build a portfolio that allows you to navigate storms without panic, rather than chase gains that could upend decades of planning. Reducing unnecessary risk does not mean abandoning opportunity. It means choosing wisely. It means aligning each decision with your actual goals and tolerances, not with what you once thought exciting or impressive. Simplifying your approach eliminates the noise that erodes judgment. Protecting capital before chasing growth ensures that the next downturn does not require emergency decisions, forced sales, or long-term compromise. This is a mindset built on wisdom rather than fear. Wisdom recognizes that life's second half is not about racing. It is about steering. It is about controlling the variables you can, accepting the ones you cannot, and making sure that temporary volatility does not define your long-term outcome. It is about approaching investing not as a thrill or a competition, but as navigation, moving steadily toward your future while avoiding unnecessary hazards. The second half of life rewards those who understand this, those who stop racing, who stop constantly reacting to short-term movements, and who focus on resilience and predictability. The goal is not to win the market. The goal is to arrive at the future intact, confident, and free, to make decisions from a place of clarity rather than stress, to enjoy the years ahead without constantly checking balances, second-guessing choices, or wondering if a single downturn could undo decades of work. Ultimately, success after 50 is measured less by how much you earn or by market rankings, and more by the quality of life you preserve, the options you maintain, and the peace of mind you achieve. It is about knowing you can weather storms, recover from setbacks, and continue moving forward without unnecessary risk. It is about embracing the quiet, patient, and deliberate path to long-term security. If you found this guidance helpful, subscribe now to stay updated with practical insights on financial resilience, investing wisely, and building a secure future after 50. Your future self will thank you for the decisions you make today.